The information provided in this communication is for informational purposes only, and does not constitute financial advice. It is important to note that past performance is not indicative of future results. Please consult with a qualified financial advisor to determine the suitability of any investment strategy.
Welcome back to the deep dive. If 2025 felt like a financially relentless year, you are definitely not alone. We are taking a look at a document that sort of summarizes survival after extreme volatility. The Orcelus Fund's 2026 report. The report opens with the CEO, and he uses this powerful metaphor. He said 2025 was one of the toughest economic periods in the last 5 years, and he likened it to sailing directly into a huge storm. But the story isn't about sinking, it's really about endurance. He says their boat endured the storm, and they found the light on the other side. So our mission today is to unpack that survival manual. We want to see what strategic pivots the fund made and how those high-level decisions can translate directly to strengthening your personal finances.
That's absolutely essential. We're moving beyond just, the quarterly results. We need to analyze the strategic DNA of resilience. We have to understand how they navigated this massive macro volatility, from geopolitical risks to the real economics of the AI revolution, and apply those lessons to how you manage debt, leverage, and your long-term investments.
And before we get into those chalky waters, we should probably acknowledge the one major milestone that really proved the strength of their portfolio. Despite the global economic headache, the fund saw this huge surge in growth because Google Alphabet officially joined the $3 trillion valuation club.
Right.
And that surge was catalyzed by the resolution of its huge, years-long antitrust case. The court decided not to split key assets like Chrome and Android.
Which was a huge vote of confidence for these big integrated tech companies, right when everything else felt so fragile.
A powerful moment of clarity for sure. So let's start with the fog, as you called it. The continuation of these sweeping tariffs implemented by President Trump.
Yes, which have pushed U.S. tariff rates to levels we just haven't seen since the 1930s. The Orcelus Fund dedicates a lot of analysis to opposing this protectionist policy.
It's a very aggressive move toward isolationism. The fund lists several core objections, but let's focus on the economic friction this creates, here at home.
Right. Fundamentally, they see tariffs as, nothing more than taxes. They're not paid by foreign governments. They're paid by U.S. consumers and U.S. businesses.
Which leads directly to higher costs for everything we buy.
Everything. And it immediately reduces our export competitiveness abroad. It just makes American products more expensive on the global stage.
But wait, isn't isolation sort of the goal for protectionists? If the U.S. is just focusing on its own domestic economy, why should we worry if China is making friends somewhere else?
Because the world isn't static. The fund argues that this policy jeopardizes the long-term U.S. position as the world's leading economic power. By backing out of these trade agreements, the U.S. creates a strategic vacuum.
Okay.
And this vacuum allows China to leverage that friction to strengthen its own relationships, particularly in Southeast Asia and Europe. It effectively positions China as a more reliable trade partner.
And that compromises the diplomatic leverage the U.S. needs. And this isn't just theory, right? The report brings in a cautionary tale from history to make its point. They talk about the Fortress New Zealand model before 1984. Why are we spending time on 1980s New Zealand? How does that connect to the average American consumer today?
Because it's a perfect illustration of the economic stagnation that protectionism inevitably brings. Before 1984, New Zealand operated under this autarkic model led by Prime Minister Robert Muldoon. It was a state-controlled system with pervasive government intervention. They used highly restrictive import licenses and quotas to control what came into the country.
Which means what, exactly, for the person on the street?
It meant New Zealand consumers were forced to buy domestically made goods that were often overpriced.
And probably not great quality.
Low quality and with very limited choice. The economy just wasn't innovating because it didn't have to compete. And on top of that, the government imposed things like financial repression, so the exchange rate was fixed. It was hiding the country's real financial vulnerability.
So the lesson is that this kind of closed-off system stifles the very growth it's meant to protect.
Yes, it leads to stagnation until the whole system collapses, which it did. And it required the dramatic free market Rogernomics reforms in 1984. Protectionism is a short-term political fix that ultimately kills long-term progress.
A potent lesson. Okay, let's pivot from the macro environment to how the Orcelus Fund managed its own ship. They achieved an over 30% return over the last 5 very tumultuous years, so it seems counterintuitive that in a volatile era, the fund is moving away from external growth.
It's all about disciplined capital stewardship. They're looking at the market and seeing persistent low interest rates, paired with really high public equity valuations.
So buying other companies is just too expensive right now.
It's very expensive. And in this environment, M&A activity rarely meets their strict criteria for value. They would rather focus on optimizing their existing portfolio than risk overpaying for a merger that won't significantly boost shareholder value.
And this is where their investment decisions get really fascinating. Let's talk about the gold decision. They added a small 5% investment in a gold ETF. They specifically avoided cryptocurrency, saying they just didn't understand it, and preferred gold because it's simpler and known.
Right.
But why now? Gold has lagged the S&P 500 and Bitcoin for years.
They see it as a shift from valuing pure safety to, well, recognizing overlooked potential. Since about 2011, the market has prioritized growth assets, leaving gold, the safety asset, kind of undervalued. Gold's current market cap is around $29 trillion, which is a lot, but it's significantly less than the S&P 500's $57 trillion.
So they're arguing it's underscaled for its future utility.
Exactly. They see a future-proofing element that's tied directly to the AI revolution. The argument is that future AI development, we're talking high-performance computing, advanced GPUs, especially quantum computing systems, will dramatically increase demand for gold and components.
Because of its conductivity and reliability.
Its superior conductivity, reliability, and corrosion resistance at the nanoscale. Gold is an essential part of the infrastructure that will power the whole AI boom.
That reframes gold completely, not just as a hedge against inflation, but as a crucial technological input. That's a memorable insight. We also have to talk about their very strategic and controversial client policy. The fund will no longer accept new clients over the age of 60.
Yeah, that one raised some eyebrows. It's an ethical and a practical choice that's really rooted in their compounding strategy. Their ethical belief is that people at that age should be, transitioning to asset preservation, enjoying retirement, not aggressively seeking new growth.
And practically,
they're shifting resources to support younger clients, those who are still in the exponential accumulation phase, to help them build wealth from the earliest possible stage. They're prioritizing decades of compounding time over short-term returns.
that focus on decades brings us right to the biggest technological driver in the report, AI. The report directly addresses the panic around Google's dominance and the comparison analysts were making to failed giants like BlackBerry, Nokia, and Kodak.
And those analysts just fundamentally misunderstood Google's competitive moat. Google was valued at $3 trillion. It didn't collapse because the market failed to account for its vertically integrated innovation engine. We're not just talking about the Gemini models or cloud.
It's the infrastructure.
It's the proprietary data center infrastructure. And crucially, it's the development of the tensor processing unit, the TPU, their own custom silicon. This in-house chip development now challenges NVIDIA directly. They control the whole stack.
But the shadow of the dot-com bubble is still so long. Let's break down that cautionary tale, because understanding the past bubble is the only way to get why this AI boom isn't an immediate crash.
The dot-com era, especially leading up to the crash in March 2000, was defined by complete disregard for unit economics. The mantra was, get big fast. Companies focus purely on metrics like user growth eyeballs, rather than profitability. Only about 14% of internet IPOs back then were actually profitable.
And the valuations were just pure frenzy. The average first-day return for an internet IPO in 1999 was over 260%. I mean, look at the failures. Webvan spent $1 billion on infrastructure before they even had real demand. Pets.com had negative unit economics because they were shipping heavy bags of dog food for free.
They were pouring money into a structure that couldn't possibly sustain itself. And here is the core defining difference between then and now. The dot-com bubble saw capital flow to largely unprofitable companies with unproven models. They failed when the funding dried up because they had no cash flow.
Whereas the AI boom is different.
It's fundamentally different. Capital is flowing through highly profitable giants. The Magnificent Seven are financially sound, cash-generating machines. Investment is driven by proven, massive demand for specialized resources, like GPUs, to deliver measurable productivity increases. So we're dealing with real technology and real profits, but we're still facing these sky-high valuations. What's the final assessment? Bubble or not?
The conclusion is firm. It is not a systemic AI bubble. The demand and the technology are genuine. However, extreme investor expectations have layered a huge amount of risk onto current valuations, leaving, virtually no room for error.
So if a company like NVIDIA misses earnings by even a tiny bit,
A sharp correction, a steep drop in price, is highly likely. But a systemic collapse where the whole foundation fails is not. The foundation is robust, but the price tag is fragile. That is probably the most valuable distinction you can make for our listeners right now. So let's bring these high-level corporate lessons back down to earth and focus on your financial journey. The report makes a crucial point about personal wealth. The old idea that just hard work alone accelerates prosperity is, well, it's insufficient now. Success demands intelligent leverage.
And this requires a major perspective shift, especially on what we traditionally view as assets. The report explicitly states that owning your own home with a mortgage is largely a leveraged lifestyle asset. It gives you utility shelter, but it actively consumes capital through interest, taxes, and maintenance.
So while it's a necessary part of life, it's not a true wealth-generating investment because it's a net consumer of cash, not a generator.
Precisely. And you can see this when you look at how the truly wealthy structure their finances. The report notes that the wealthiest households, those with a net worth over $5.4 million US, they hold a lot less of their net worth in their primary home.
Where's their money then?
They derive significant wealth, around 18% of their total assets, from financial markets, stocks, bonds, structured investments. Their money is actively generating compounding returns for them.
That really shows the power of strategy over simple consumption. Let's use the fund's metaphor of leverage, the fulcrum diagram, to illustrate why debt is so devastating.
Okay, so think of it this way. Debt is the massive, heavy ball placed furthest from the fulcrum. That positioning maximizes its gravitational pull, and that symbolizes compounding interest working against you.
And my income.
Your income is the stick figure pushing down. That's your effort, your labor. Investment is the strategic advantage. It creates leverage, a counterforce, right near the fulcrum. Compounding returns act as that counterforce, making your income exponentially more effective at lifting that massive debt burden.
That diagram is powerful, but is it realistic for someone on an average salary to create that much investment leverage while they're also balancing all this debt?
It forces an immediate prioritization. The absolute top priority has to be aggressively paying down non-productive personal debt. Low debt acts as essential insurance against unpredictable downturns, like job loss. It lowers your fixed expenses, and it protects your existing wealth from being sold off under stress. You have to reduce that gravitational pull first.
Let's look at the ultimate cost of poor leverage, losing compounding potential in retirement savings. The report highlights a pretty alarming crisis. Hardship withdrawals from retirement funds have soared.
Yes, to unprecedented highs, often driven by the immediate pressure of the cost of living crisis. And this puts policymakers in an impossible spot. The fund does support allowing people to withdraw the dividends from their retirement savings to ease debt. That's earned income. But they vehemently oppose allowing access to the principal amount. They cite the high risk of poor, stress-driven decision-making where short-term relief leads to a catastrophic long-term loss.
So to solve this, they're proposing a standardized approach.
Yes, a tiered severity risk level system, from level 1, which is small debts, up to level 4, which is imminent bankruptcy. It aims to standardize access, ensuring withdrawals only happen when the need is truly critical.
The data on the lost opportunity is just sobering, especially for younger people trying to buy a house. The average balance for a 36-year-old, the average first-home buyer age, is only about $30,437. If they pull all of that out for a down payment, they face two huge risks: lost compounding potential and concentrated risk in a single non-liquid asset.
And that $30,000, it might seem like a lot today, but its future value is incalculable. To show the goalpost, the fund recommends an ideal savings target of $160,000 by age 36.
Wow.
Think of the difference in strategy. If a 50% withdrawal limit were enforced on that higher amount, it would still give you $80,000 for a home, a meaningful down payment. But it would leave $80,000 in there, compounding away.
And what does that remaining $80,000 do?
That remaining principal could generate a meaningful dividend of, say, $2,400 a year, which could go right toward the mortgage principal. It starts working for you immediately. The fundamental long-term cost of premature withdrawal is the forfeiture of the exponential future value those funds would have achieved. You're forced to replace capital that was growing exponentially with capital accumulated linearly through your labor. You just lose time.
The one asset you can never replace. That's the ultimate lesson in intelligent leverage. So what are the three main takeaways from this deep dive into the Orcelus Fund's survival manual?
First, I think, is the necessity of disciplined capital allocation. Prioritizing internal excellence when external opportunities are overpriced. Second, recognizing that core difference between a genuine tech revolution like AI and a purely speculative bubble like .com.
And third,
And third, and most importantly for you, the listener, the critical need to aggressively manage personal debt to create this space to start your own investment journey early and really harness the power of compounding.
And beyond the numbers, the CEO's final moral compass kind of offers direction for all of us. Enduring value is created when profit and purpose are aligned.
It is. But what's fascinating is that even after navigating their way through that financial storm and finding the light, the report ends on a really sober note about the global climate.
Indeed. Despite their survival and internal clarity, the final warning suggests the international environment signals a severe period of escalating antagonism and intense conflict between nations. It warns of a terrifying new geopolitical storm that demands continued vigilance, even as we focus on our own internal financial excellence. The fight for stability, it seems, is far from over. A compelling and I think necessary roadmap for the years ahead. Thank you for joining us on this deep dive. We hope the insights into leverage, gold, and the true cost of compounding help you navigate the choppy waters ahead. We'll talk to you next time.